Welcome to Put Paradise. Just want to remind you to head over to my website, putparadise.com, which is focused on options trading and provides training content to beginners. We're delivering consistent returns, potentially 50% annual rate of return, while trading for only 15 minutes per week. You can download my free guide called the Put Path Options Trading System, which is a checklist that outlines our trading methodology. Okay, so today we're going to get into break-even points and trying to understand what that means. So let's go over a trade that I put on yesterday in USO. So you go to your Robinhood app, go down to your positions, and then click on USO in this example. Okay, so we put this trade on, we sold the 64 put, and we bought the 60 put for protection. We had an average credit of 33 cents. And you can see here the current price is 46 cents, so it's actually gone up, which is a bad thing for us. So the total return so far has been $130 loss. So one of the things that's cool about Robinhood is they do provide this simulate my returns segment so you can understand some various options. So let's click on that. Okay, so you can see here at the bottom, our trade goes out 28 days to expiration. So we are currently December 27th, and the trade expires 4 weeks from now. So one of the things you can do is look at changing the price of that stock to see exactly what would happen over time. So currently the price is at $68.75. Now, since we sold the 64, we're in a very good position. So the break-even point is actually 33 cents less than 64. So it's at 63.67, which is good. That's a $5.08 drop from where we currently are. And that allows us some wiggle room, about 8% drop before we start to lose money. So we're in a current max profit position. Now, as that stock, let's say, drops to, let's say, 64 is the break even or the strike price. You can see you still would make a little bit of money if it dropped to 64. How much would you make? You're going to make the full max profit. Now, as it starts to get below 64, that's when things start to change quickly. So if we go down to the true break even, which is 67, you're going to get a 0 simulated return there. But what that means is you take your strike price, which is 64, you subtract out your original credit, which is 33 cents, and you get to 63.67. So as you lose stock price, let's say you go down to 63, so you're going to hit max loss pretty quick. So max loss on this trade is going to be let's see. Let's say we go down to around 60. Okay. So max loss on this trade is 3,670. So the current collateral or capital at risk is 4,000. We have a credit that came to us upon initiation of the trade for 330. So 4,000 minus 330 gives us a max loss of 3,670. Okay. So obviously we don't get into these situations because we manage trades early. But you can see here what would happen, and happen fairly quickly after we breach the strike price. So again, we're good up until 63.70 technically. That's our break even. As you can see here, the simulator returns back to zero. And as we start to go up to 64, now we're back to max profit. So things change really quickly between the strike price. If you're a little bit less than the strike price, a little bit more than the strike price, things change very quickly at the end. So we don't like to get anywhere near that. In this system, we close out when we have a 2x loss. So we never go in the money, and we always close before expiration. We want to avoid assignment risk, and we want to avoid these huge losses. So oil is very volatile. Depending on the market, can drop, several percent every day. So 64 again would be our break even. So we don't want to get anywhere near that, because you kind of lose control of the trade after that. Let's say you woke up, and instead of it being at 64, now oil's at 62 on that last day. Now you've lost $1,670 just like that. So you don't want to mess around with that. So that's not how we trade. We always stay in the money. We always make sure that the underlying is above our strike price, which leaves us in the 100% profitable zone. Okay? So again, what this allows you to do is kind of simulate your return. You can move along the date in a simulated fashion. So let's say oil did go down to 65 on this coming Monday. We would have a minus 700 in our position if we were going to buy that back. But if it stayed there, which it wouldn't, but in this example, if it stayed at 65, through theta decay, through the time that we still have left on the trade, eventually it would flip to profitable, and you'd be able to close it out at that max profit. So this is a very nice tool. You can conceptualize time, you can conceptualize different scenarios based on the price of your underlying. So this helps you make decisions along the life of the trade. Really not a whole lot of decisions that we make. It's really just hold it for the max win or close it out early at a minus 200% loss. But this tool is very nice. It can help you conceptualize what's going on behind the scenes with all the Greeks and the pricing model from the Black-Scholes model. So hopefully this was helpful. And again, if you haven't checked out my website, pop on over to putparadise.com, and we can provide additional learning and training materials.